Hi there, Investorholics. Thanks for tuning in to another ETF Spotlight review. Today we'll be taking a look at ASX Gear, which is the BetaShares Geared Australian Equity Fund. A little interesting, this one. A little exotic. Definitely worth hanging around and spending the extra 5-10 minutes to have a bit of a look at it and get an understanding of what this one does. Well, hello there, Investorholics. This is Scott. KrackTheSky Value Investing will be giving you up-to-date investing news and content so you can navigate the markets wherever you are. My mission is to give you the knowledge and confidence to take control of your own personal finances, expand your investment horizons, and crack your financial sky. Okay, let's dive right into this one. So the investment objective, it's a simple way to obtain a cost-effective geared exposure to the Australian shared market in a single ASX trade, removing the need to borrow funds yourself or risk a margin call, so you don't have to go to the bank and borrow the money yourself. You can just do it directly through this ETF. The fund is internally geared, meaning all gearing obligations are met by the fund. The fund combines funds received from the investor and with the borrowed funds, and invest the proceeds in a broadly diversified share portfolio consisting of the largest 200 equities securities in the ASX by market capitalization, so in the ASX 200 index. The fund's gearing ratio being the total amount of borrowed expenses as a percentage of the total assets of the fund is managed between 50 and 65%. So leverage return, so gear gives you the opportunity to make a significant gains when the Australian stock market rises, and obviously if it goes down you have magnified losses. This is a simple, convenient way to access borrowing leverage. So it avoids the costs and complications of a margin loan or a CFD. So yeah, there's no need to borrow funds, no credit assessment, and it also gives you diversified exposure in one single trade. So as we said, there's no margin calls. Investors in gear do not face the possibility of a margin call. But as with all these things, gearing magnifies the losses and the gains, and may not be a suitable strategy for all investors. Okay, let's have a look at some of the numbers. Net asset value as of Friday was $14.31, so trading just above that at $14.61. Management costs are relatively high, but like there's a bit of to and fro goes into the loans and things for this one. So they charge you a bit more, so 0.8%. Distribution frequency is semi-annually, so January and July. Dividend yield's quite high for this. It's 14.1%, but that's just a reflection of the risk that is associated with this product. So in general, borrowing money to invest in shares is an incredibly risky strategy, and if the market turns against you, you could be facing greater than 100% losses or even bankruptcy. If you are interested in a lower risk entry using leverage, then geared possibly could be one for you. Allows an investor to obtain magnified returns from the share market. As we sort of touched on before, the great plus with this ETF is that there's no margin calls for the investor to worry about. All calls the fund's responsibility, so the fund borrows the money, so they actually have to repay it if there's any margin calls. If you're interested in using gearing, then this ETF may be a somewhat safer way to do it. Definitely only put a small portion of your portfolio into something like this, because there is quite a bit of risk associated with this type of product. The fees for this ETF are typically lower than those charged by other managers of geared products in the marketplace. So because this is a type of passive type of thing. The ETF it tends to be a little bit cheaper, but yeah, for me, I think just the risk sort of outweighs any benefit for this one. So if you're also looking for another alternative, check out GGUUS. So it does effectively the same thing, but focuses on the American stocks. So on the left hand side there you can see the top 10. It's ASX 200 and it's all the big ones. So the companies are relatively stable. Pretty much just it's a bet on the overall market going up or down effectively. So you can see what's happened to the performance, total return there. At the end of February you can see the huge downturn it's been through. This product wasn't actually running, or it didn't exist in 2008, 2009, so we sort of can't have a look at how it performed then. But you can see the volatility in that graph, extreme volatility towards the end there in February. So to me, it's definitely something that if you're willing to take that, accept the high levels of volatility investing, then maybe something that you would be interested in. But for me, I like something that's steady as you go. I don't particularly like gearing because you can actually lose more money than you invest, so you potential to go negative. So this type of thing, you definitely want to be getting some professional advice before you even went anywhere near it. So note that the fund does not track the published benchmark. Past performance is not actually an indicator of the future performance, as with all these things. So this one sort of doesn't really track a index. It just kind of makes shit up as it goes along, which if you're into that type of thing, maybe that's for you. But for me, this one's a definite no. Something to definitely stay away from. Extreme caution. And as I said before, if you do want to use this strategy, definitely only make it a 5 or 10% of your overall portfolio, so you're not overly exposed to any downside risk that's actually involved in this ETF. Are you interested in learning more about personal finance and investing in the markets? If you are, then smash the like here on the left hand side and caress the subscribe button on the right hand side. It's Crack the Sky Value Investing. We'll be giving you up-to-date investing news and content so you can navigate the markets wherever you are. Expand your investment horizon and crack your financial sky. Thanks guys. See you later.